Have you ever wondered what happens when a fund holds assets that cannot be easily sold, especially when investors want their money back? It is a complex challenge that many investment vehicles face. Side pockets significantly impact fund liquidity by segregating illiquid assets from the main portfolio, effectively ring-fencing them. This mechanism prevents the illiquid assets from unduly affecting the valuation and redemption process of the more liquid investments within the fund. The core reason behind this impact lies in the fundamental nature of illiquid assets themselves. These assets, such as private equity investments, real estate, or certain distressed debt, do not have active markets for immediate sale. If a hedge fund were forced to sell them quickly to meet redemptions, it would likely incur substantial discounts, harming all investors, including those who wish to remain in the fund. By placing these assets into a side pocket, the fund isolates the liquidity risk, ensuring that the main fund can continue to operate with a higher degree of liquidity for its other holdings. This separation allows the fund manager to manage the disposition of the illiquid assets over a longer, more appropriate time frame. To understand the practical implications, imagine an investor seeking to redeem their capital from a hedge fund. If that fund utilizes side pockets, the redeeming investor would typically receive their pro rata share of the liquid assets from the main fund, while their share of the side-pocketed assets would be distributed to them only when those assets are eventually realized. This means the investor's full redemption is split into two parts, occurring at different times, which directly affects their immediate access to capital. A key nuance to appreciate is that side pockets are typically created in times of market stress or when an asset unexpectedly becomes illiquid, acting as a protective measure rather than a standard investment strategy. Funds employing side pockets often include specific provisions in their offering documents, outlining how these assets will be valued and distributed, which is crucial for transparency. Furthermore, the establishment of a side pocket often requires investor consent or explicit authorization within the fund's governing documents. Ultimately, side pockets serve as a vital tool for hedge funds to manage the inherent tension between investor redemption rights and the fund's ability to hold less liquid, potentially higher-returning assets. They protect remaining investors from forced asset sales, while also informing redeeming investors about the staggered nature of their capital return, thus clarifying the true liquidity profile of their investment.